everyone right now, the big hot button issue that we're running into are interest rates are too high and the home prices are too high, right? But we all know that one of those two things is not necessarily true right now. It may have been true in 2020, 2021, the first part of 22, but it's definitely not right now as far as home prices being too high. We're still seeing, and everyone can see my screen, correct? Okay, good. Got to make sure. So let's talk about it. So we, in those scenarios when people talk about rate, we have to be the overcomer. And this is something that I do on calls all the time. So someone hits me up and they're like, yeah, I'm really thinking about buying this house, but interest rates are way too high. And I feel like I'm going to wait for the market to crash. Well, I always ask them the same question. What do you think is a high interest rate? And they'll answer back with, I mean, like 5% seems really high. I'm like, okay, 5%. So what about your credit card? What's the interest rate on your credit card? And they're like, oh man, I think right now it's like 25%. I'm like, wow, that seems like a high interest rate to me. And I'm like, what about a car loan? So a car loan's pretty short term. It's about, 60 to 72 months. I think the average right now, just because of the way car prices have gone, is actually 72 months on a lot of these big paper sheets that they put together for sales. And then, of course, payday loans, we all know those are brutal. We don't even need to get into that, but that's like 400%. And it's over like a 2-week period. And then, of course, you have a home loan. All right. We're talking 7% over 30 years. All right. Let's do that again. That's 7% over 30 years. Jaime, if you can name something, a loan somewhere where you can get 30 years on it at 7%, I mean, I'll stop doing home loans right now. Does that exist? Do you have that? No, we don't. It doesn't exist. So literally, even at 7%, this is the cheapest money with the longest terms you'll ever get. And since we're not operating like we did way back in the day, you can pay off your loan early. Wow, crazy, right? So there's no balloons, there's none of this. It's fixed, and you can pay them off early with no prepayment penalty. So I moved the conversation from rate after we've established that, hey, rate is really not what it's all about, right? This is still cheap money. In Texas, and I don't know where a lot of the other agents are, who is not in Texas? Can you say where you're from? If you're not in Texas.
We have a good amount of people not in Texas. So to show city and state, if y'all want to drop it in the chat, city and state, a good portion of us aren't, Ian.
Okay. So in Texas, and this can apply elsewhere too. I mean, I know California taxes are pretty cheap. I've seen a lot of those come through. But in Texas, all my Texas agents, we know that our property taxes are insane. Like, can be absolutely insane. So in Texas, I've been switching the dialogue over to, you really should be paying attention to property taxes. You can always get cheaper homeowners insurance. You can drop MI if you have it once you hit 80% loan to value. You can refinance the rate, but you cannot stop the property taxes from coming. They're going to continue to go up. You can even fight them. If anyone in Texas fought last year, you realize that was a losing battle real quick because we had sold those houses for way too much money and that was going to come back to us, right? So I divert the conversation over to something else. In this case, in Texas, I'm using property taxes. We can brainstorm some ideas for elsewhere in other states because I'd have to, really hone in on that market and see. Because I did 20 different scenarios with a family the other day, and they had 20 different houses that they wanted to look at. And the houses all were basically at $250, and the payments varied so widely because the property taxes were much higher. So they're like, you're telling me that this house listed at $250 is $2,800 a month. This house listed at $250 is $2,600 a month. I'm like, yes. They're like, why? I'm like, property taxes. That's literally it. Your principal and interest will always stay the same, but your property taxes can move. And they're like, oh, wow, okay. So it's really not all about, just the rate. No, you got to look at property taxes. Look at it holistically and your future within the home. Now, I had someone ask a question about, buying down the rate permanently versus other types of scenarios, and we'll get into them. So when you're talking with your client, you can definitely say, you can have the seller buy a point if you're on the buyer's end of things. You can put that into your initial contract. Say, hey, we're looking for 1%. Now the maximum you can do for seller's concessions on conventional loans is 3%. Don't forget that. That's super important. And the maximum you can do on Govy, which is going to be your FHA, your VAs, you can get up to 6%. So those are big deals, because a lot of the times, I know y'all remember the markets previous where we could get sellers to basically send enough money in to where all we had to do is worry about getting the down payment together. And we're seeing more and more of that come to fruition, but instead of using it toward the closing costs, we're using it toward the buy down. So just getting a 1%, 2% lump from people and putting that in the initial offer is going to make a huge difference. Because let's say our qualifying rate is 8%, which means it's your par rate, which doesn't mean, it means it costs the borrower nothing and they don't have to pay anything additional. Right now, at the time of making this, it's almost 1-to-1. So you pay 1 point, which is 1% of your origination. So if they're doing a $100,000 loan, that would be 1%. But in your wording, you're going to do it off of the price of the house, which means your client actually gets more money toward rate buy down. Does that make sense? So the actual rate or actual point cost is according to loan amount, but you guys are requesting upon the purchase price of the house, which means they actually get more money to play with to buy down their rate. So you get permanent rate buy down, long-term savings, all that kind of good stuff. Because if rates go up, they're going to be happy that they did it. Because if rates hit 10, which I don't think they will, they're insulated from that 10% rate, and they have probably the best rate at that time, and it's going to be good long term. Now we have the 2-1 buy downs, which I'm sure everyone has seen videos about that, seen stuff out there about that. Correct me if I'm wrong. And then we have 3-2-1 buy downs. Now these can only be paid by the seller. Okay, so a lot of the builders are trying to put in the 2-1 buy down incentives, the 3-2-1 buy down incentives, and it's just as the name implies, but the cost to the seller is quite a bit, and you would need to hit up your lending professional on that, because if they're putting 5% down, the 2-1 buy down costs a different amount. If they're putting 20% down, it costs a different amount. And I can get into that a little bit later with the sheet that we have. But it does change the amount that the seller needs to contribute based upon how much they're putting down and how much they're originating. So on a 2-1 buy down, it is a temporary buy down. The first year is 2 points off. So if your initial rate was 8, you're going to be at 6%, then 5%, and then the full rate years 3 through 30. Does that make sense? Raise your hand so I know that it makes sense. Good. And then 3-2-1 starts out with 3 points off. So if the initial rate was, let's just use easy numbers, 5, that means the initial rate's going to be 2. And then the next year it's going to be 3, 4, and then finally it's going to be 5%, 4 through 30. But a lot of people think maybe this is the way you can get somebody qualified who may not otherwise be qualified, but they still have to qualify at the full rate at the buy down end. Okay? So you're not going to magically be able to get somebody into a house that they couldn't get into before because of a 2-1 or a 3-2-1. They still have to qualify at that full rate. But what that does is it insulates them for at least a couple of years from that full rate in hopes that the rates do rebound. Now, one thing I am seeing that's been really good are the 7-1 and 5-1 ARMs. I don't have those at the credit union level the way that they do. But they're really, really good right now at the credit union level. You will not get this at the mortgage originator level like me. You will only get it from credit unions. And I've seen one that came back the other day for 5.875 with no points at a 7-1 ARM. So check with your local credit unions too, to see what they've got going on. But the one caveat is most of the time they require that they open a bank account with them. And that can kind of turn a lot of people away from it. But yes, your 7-1, 5-1 ARMs at your credit union level are insane. So find yourself a partner over there. They'll never be as good as someone like me as far as doing loans, But your client will, if they are having a hard time qualifying for DTI reasons, they might be able to salvage the deal.
Ian, can you explain what does that mean? 7-1 ARM?
Yeah, so the first 7 years of that loan is at that rate, it's locked. And then every 7 years it's updating. Now, at some different banks, they'll say it's a 7-1-6, and it gets really complicated on the ARM front. So we're just going to do the 10,000 foot view, which is every 7 years it will change. So you're insulated for 7 years with that rate. And their hope is that at that 7 year mark, rates skyrocket and they make their money. So at a 5-1 ARM, it's the exact same deal. It's 5 years, adjusts every 5 years. Again, they do have different things that adjust at different periods at 5s and 7s, but that's down to that credit union. So get all the info you can for real. Now, I want to see hands raised for who thinks you should buy a home with rates this high in the 7s and the 8s, hell, even the 10s. Let's go hard. Lower? No opinions? There you go. All right, that's what I'm talking about. So I always ask my clients this question when they're really teetering on the rate. They're like, oh man, it's too much. I would say, all right, what do you think happens to home prices when rates go up? The answer is prices come down, right? Because now your demand is that much smaller because there's fewer people that can qualify. And then I always ask them, what do you think happens when the rates go down? Let's see if they go back down to 2. What's going to happen? It's going to get crazy. The rates are going to go through the roof. Or not rates, sorry. The home prices are going to go through. We already saw this, right? You have evidence of the last 3 years you can point back to say, this is what happens. So right now, if you bought at this higher rate, and let's say rates come back down, they level out at 4 to 5, which is the actual prediction from Fannie Mae, which is a half government body, right? And if their predictions are that means they know something we don't. Which means if you're buying at 7 and then you refinance down to 4 or 5, you win because you get a better price on the house and you're getting a better rate. So anybody of your clients who's like, I'm just waiting for the market to crash. This is it. This is it, family. The market is crashing, but really it's just a correction. The hyperinflation that we saw, Ian, you know this, is not sustainable over time. It's just not going to work. We have to have this correction. This is needed in order to make sure we get as many people as we can into homes, right? So the market correction is happening. It's time to get those people off the fence, hit their objections, do all your role play calls, right? That you can call Jaime and say, hey man, let's do a role play call. Let's make this thing happen. And just go over it, like hit the objections, come back at them with those things. I know it seems like it's really harsh to ask somebody straight up what they think a high interest rate is. But when you've been dealing in this kind of stuff with, as long as I have with people, like it just feels right. It's like, well, what do you think a high interest rate is? Is it 24%? Is it 6? Because if you feel like 6 is high, then it's really going to suck when your credit card statement comes in and you didn't even know that it was at 24%. At least with this, you know exactly what's going to happen. You're locked in. It's non-variable on rate, and you can always refinance down the road. And if rates go to 10, you're going to thank me because you're at 7.